Whenever I hear the words Stanford study, I think about that famous prison experiment that was done, where they simulated a prison with some students playing the part of security guards and some students playing the part of prisoners. And after a certain amount of time had passed, the prison guards started being both verbally and physically abusive towards the prisoners. These were their fellow students. This teaches us a lot about human nature. However, the Stanford study that I want to talk to you about today is a recent study by a Stanford assistant professor that goes through how important mortgage brokers are to the economy as a whole and the way that mortgage brokers benefit both buyers and lenders. Hi, my name is Russell McDonald. I've been a mortgage broker in California since 1992. I am also a real estate broker and founder of a fintech company where I invented systems and business methods that have earned me 6 patents from the U.S. Patent and Trademark Office. As a mortgage broker for more than 27 years, I have personally closed home loans with more than 150 different banks and lenders. And the companies that I've worked for have placed loans with more than 200 different banks and mortgage lenders. While I was developing my latest patented systems and methods, we would present them to every bank we worked with and try to get as high up the ladder as we could at each lender to try to get them to use my systems. Shortly after my patent started issuing, we got as high as the CFO at one of the 5 biggest banks in the country. And we got it to the head of cross-selling at another one of the top 5 banks in the country. The lenders that have licensed my technology have used it to place over 1 million home loans all over the country. I went off on that tangent to illustrate the fact that when it comes to mortgages and real estate, I have a lot of experience and I know what I'm talking about. Okay, that's enough about me. Let's talk about the Stanford study because it came up with some information that I find really interesting. A recent article in Insights by Stanford Business asks, what would happen if mortgage brokers disappeared? It comes to the conclusion that mortgage brokers are not simply a necessary evil, but that both lenders and home buyers benefit from the existence of mortgage brokers. It may go against common logic to think that consumers are better off by employing a middleman and getting a home loan because our commissions represent a cost that is in some way paid by the consumer, right? Either through additional closing costs or higher interest rates or somehow, but that turns out to not be an accurate assumption. Listen, home loans are still very complicated. There are literally hundreds of different loan programs. Consumers benefit greatly from the presence of mortgage brokers because our expertise helps consumers find loan products that they might not even be aware of, or get placed with lenders that might be more competitive on a given product that the consumer doesn't even know about. Sometimes the pricing models used by different lenders offer unique price points that don't make sense. I recently closed a refinance transaction for a client at 3.625% on a 30-year fixed rate mortgage. And on the day we locked that loan, the costs for a rate of 3.625 were actually lower than it would have been at 3.875 with the same lender on the same day. In almost every case, a lower rate for a consumer means higher costs associated with that. This unique arbitrage was only available for a couple of hours on that given day and only with one of my lenders. And this client was in a position to take advantage. Likewise, lenders benefit from the existence of mortgage brokers because the fact that there are mortgage brokers enables smaller lenders that are offering lower costs to gain a foothold into a given market, and the overall costs that lenders incur in paying a commission to a mortgage broker tend to be lower than the acquisition cost for a retail mortgage client. There is a popular belief that mortgage brokers take advantage of their customers and essentially rip them off, but this study found that this simply is not true. The truth of the matter is that direct lenders try to exaggerate that myth because they're not able to compete with a mortgage broker on a level playing field. So they resort to lies and deception and spread dirt. For the average person, they may buy 2 or 3 homes in their entire life. They may refinance each home once or twice during the time they own it. It's very common for a normal person to not get more than 3 to 6 mortgages during their entire working life. Mortgages are still extremely complicated, and the online and call center mortgage lenders that have tried to turn them into a commodity have not been successful because there simply isn't a one-size-fits-all model for real estate finance. A first-time homebuyer is typically better off if they can work with a local expert to get their home loan, and if the mortgage broker that gives them that first mortgage does a good job, they will likely work with that broker again when it's time to refinance or purchase another home. When a consumer looks for a mortgage on their own, they often head to the nearest bank branch or to a bank that they use for other services, or find an online lender who advertises on TV and the radio excessively. This means that large banks with a larger footprint are more likely to easily acquire mortgage customers. Mortgage brokers, however, can carry a large portfolio of lenders and mortgage products from a wide range of banks and offer a more diverse set of options for their clients. This allows smaller, more independent banks and mortgage bankers to get access to consumers that would never approach them directly. The Stanford study found that banning mortgage brokers from the mortgage marketplace would be detrimental for the borrowers. If mortgage brokers were banned, then consumers would not hear about a variety of the loan products that are available, and big banks would have even more power in the market. This study also indicates that the use of mortgage brokers allows smaller and newer banks to introduce their lending products to the marketplace, and that these products are often the cheapest options for people. Home buyers who used a mortgage broker were 7% more likely to get these types of mortgage options than those who didn't use a mortgage broker. This study brings up concerns about possible ulterior motives by mortgage brokers in the United Kingdom specifically, because some of these boutique lenders offer them higher commissions, and the stats show that if the lender increases a commission on a mortgage product by 10%, that it is 2% more likely that a broker will select that product for his client. It also addresses the fact that in the UK, mortgage brokers may be paid by the consumer or by the lender or both. These specific concerns no longer apply in the United States. Compensation reform that came into play under Dodd-Frank as of April 1st, 2011, make it illegal for a broker to be paid by both the lender and the consumer. It also generally sets the broker compensation to a specific percentage of the loan amount, no matter what the interest rate is that is selected or the loan product. And if the lender priced out a loan so that it pays additional compensation, that benefit is applied as a credit to closing costs for the consumer. When there's additional money being offered by a lender on a specific loan, the broker cannot receive that compensation any longer. It is passed on directly to the client. For example, I closed a purchase loan for someone 2 months ago, and that lender reclassified it as being qualified for a $1,500 credit under special first-time homebuyer programs, basically under the Community Reinvestment Act. This credit was given to the client in closing to help him pay his closing costs. Before the compensation reform, the broker could have added this extra credit to their own compensation, put it in their own pocket and kept it for themselves. But now, that's illegal. So how does pricing work? A given lender may offer me 15 different interest rates at a different net cost to the client on a 30-year fixed product any given day. They may also offer me 20 or more different loan programs, all of which have 10 to 15 different rate options. At each and every one of those rates, the lender will pay me the same commission. It will be based on the loan amount. I'm not under any kind of financial incentive to steer a client to one interest rate or another, or to select one program over another. My advice to the client can be completely freed from the concept of being able to earn more money by pushing them one way or another. When I advise a client what I believe is in their best interests, I don't have a financial incentive to choose one option over another. What I like to do, I like to try and understand what the client's motivation and needs are, and then counsel them accordingly. For example, let's say you have your checking account at Bank of America. Do they have the best option for you? Maybe, but probably not. Right now, I don't place loans with Bank of America because they closed down their wholesale channel. Going back to the early 90s, there have been a few times when Bank of America has shut down wholesale, and then later on they tend to come back into the market. This latest closure has been the longest amount of time I've ever seen them out of wholesale, but these things tend to repeat themselves. When they had a wholesale channel, I was able to offer their loans to customers at better rates and terms than those advertised in branch, but they never got 100% of my business because they didn't have the best home loan for every situation. They never even had the best pricing for a majority of clients that I had at any given time. I had similar experiences when I was submitting loans to Wells Fargo, Chase, Citibank, SunTrust, many more of the big banks. No single lender has ever gotten 100% of my business at any given time because none of them can do everything well. None of them ever do a great job at everything. So now, a really interesting phenomenon to come out of the financial crisis is that the largest lenders tried really hard to crush the entire mortgage broker channel. Why would they do that when they were making so much money off of mortgage brokers? Because if they were successful in eliminating mortgage brokers overall, they would have more of a monopoly over the home loan system in general. The Stanford study points out that if mortgage brokers were eliminated completely, the average cost of a home loan in the marketplace would increase by 25% because mortgage brokers help bring more healthy competition into the home finance arena. Along with that increase in 25% in costs, the study also points out that bank profits on mortgages would increase by around 12% at the same time. They wanted to drive mortgage brokers out of business, not to save the commissions that they were paying us, but to charge you additional closing costs and increase their profits. The study also indicates that the largest banks would increase their profits by a lot more than the mentioned 12%. Wow. Okay, so through the past decade or so, Bank of America, Wells Fargo, Chase, Citibank, they've all closed down their traditional wholesale channels. Frankly, we haven't missed them because those banks never represented an overabundance of our funding sources. Most of our clients were given better results by having their loans placed with better mortgage lenders. I was recently talking to a retail loan officer with Bank of America who told me that on refinances, they are pre-locking for 90 days up front, that's 3 months, and that it takes them 60 to 90 days to close that refinance. Now, they're still able to close a purchase in just under 30 days, but generally, I close purchases in 10 to 15 days and refinances in 15 to 22 days. I can't imagine a bank the size of B of A allowing that level of customer service, but there you have it. For example, my most recent closing took us 3 business days from the application date to the closing disclosure being ready. Closing disclosure on a residential home loan is required 3 business days before the clients are legally allowed to sign the final loan documents. This client tried a year ago to get their refinance done. They went to an online lender that they found who's one of the 10 largest mortgage lenders in the country. I don't want to say their name, but I really don't like them. I've used them before on the wholesale side too, and that was a complete nightmare for me. Can you imagine how hard it was for them? In their case, this lender kept requesting more and more and more documents over a 2-month period and made the clients pay for their appraisal up front and still failed to close the refinance. It was a hassle. Everything was a problem with them. And these friends of mine did not get their mortgage because large, big box call center lenders make a lot of mistakes whenever something starts to get off track. When they came to me, they were signing their final loan documents on a refinance 9 days after applying. And it could have been even sooner, but one of them was out of town. They couldn't believe it was possible to get a home refinance done with so little time and effort on their part. Needless to say, these clients are delighted with my service, and they will not be trying to go to online lenders in the future when it's time to refinance again. Let's be honest. When you personally go to get a mortgage from a mega bank that offers both a retail and a wholesale channel, that lender only expects to do at most 2 or 3 mortgages for you during your entire life. This means your specific transaction is not important to them for their survival as a company. All the lenders that I work with want and expect more than 2 or 3 transactions from me every single month. For this and other reasons, the business from a high-producing broker is always more important to a lender than the business from a single customer. A benefit of working with a broker is that if for any reason operations get really backed up at a given lender, we can always move your transaction from that lender to another one, even midway through the home loan process. The fact that lenders know that I can pull a file from them at any time also makes them more responsive if there's some kind of problem. Something else that happens sometimes is that I find really interesting is that a lender may make a mistake on their pricing formulas and offer rates that are exceptionally good on a given tier. They tend to reprice as soon as they notice the error, but I've never had a wholesale lender refuse to honor the posted pricing if we lock it in before a reprice. I remember one day, Wells Fargo offered a ridiculously low rate on their 10-1 jumbo arm, and it was a 1-day pricing glitch. Basically, somebody made a mistake. That day, we called all of our clients that were in that type of financing or other interim fixed-to-arm products and offered it to them. On that day, the rate should have been around 5.25%, and we were able to get it for 4.125 to 4.25 for our clients, and we locked a lot of them on that day. If you work directly with a lender, the only way you're going to learn about a 1-day price special like that is if you happen to be working with the lender that has the special already. We were able to reach out to all of our clients and offer them that special on that day. Now, a fascinating tool that I invented is my patented rate tracking system, which I call Rate Analyzer. Once I have your current details in my systems, if at any time you are eligible for a cheaper refinance under a no points, no fees basis, I can let you know and offer another refinance. I make this so easy that when you consider the $50 to $100 you might save per month every time this comes up, you won't think it's too much of a hassle to justify the effort. When you do a mortgage transaction with me, my goal is for the most time-consuming part during the entire transaction to be the signing of the final loan documents. The way that most people can save the most money during their many years of homeownership is to work with an innovative mortgage broker like me who actively manages your mortgage obligations and tells you when the time is right to change your mortgage. When you are able to do a no-cost refinance at a cheaper rate than you already have, Look at it like having an adjustable mortgage that can only go down. Now, at any time when you're refinancing, you can pay extra points and fees to get an even cheaper rate, but most people are not successful when they try to beat the markets that way. It simply doesn't work out in most people's favor because our interest rate markets swing up and down so violently over time. Now, there are hundreds of reasons why most people are better off working with an independent mortgage broker when it comes to time to purchase or refinance their home. These are going to be topics for other videos later on. Before the financial crisis, mortgage brokers had gotten up to almost a 70% market share. And with all the fallout afterwards, this dropped to under 7% of the market share, and mortgage brokers were unfairly blamed for all the financial woes in the economy. The true cause of the problem is that Wall Street firms basically packaged up shit, if you'll pardon the expression, and they sold it to you as caviar. And then they bought insurance on it as if it were caviar, insured each bucket of caviar many times over. When it was discovered that the caviar was worthless, these insurance policies paid out. Basically, they found a really clever way to steal money from pensions and insurance companies and retirees, and then it used the mortgage broker as their whipping boy to take the blame after the fact. Lucky for you, times are changing. Independent mortgage brokers are regaining their foothold in the housing marketplace, and thousands of retail loan officers are making the switch back to being brokers again. Latest figures show that the mortgage broker market share has crept back up to almost 20% of the market and is still rising. The important information provided by this Stanford study highlights the fact that mortgage brokers are useful to both lenders and to end consumers, and that mortgage brokers help decrease the overall costs of getting home mortgages. Remember, one statistic brought out by the study is that if mortgage brokers were banned, the cost to get home financing would increase by around 25%, and banks' profits would increase by an average of 12%, and that amount would be even higher for the biggest banks. Next time you need a home loan, get a referral to a local independent mortgage broker and see what they can do for you. If you're in California, I can help you out. If you're in other states and don't know who to ask, talk to me. I have a network of over 3,000 independent mortgage pros all over the country. Many of them have my same high standards for customer service, and at least one of them is close to you. Thank you.